Welcome to Close of Business. I'm Alicia Barry. Around 30 shopping days to Christmas, and there's evidence consumers are feeling more confident. The latest Westpac Melbourne Institute Consumer Sentiment Index shows confidence surging by nearly 13% in November. Retailers are expecting it will translate into their biggest Black Friday yet. Nasim Kadem reports.
It's shaping up to be the biggest retail event of the year. Shoppers are already hunting for deals in the lead up to Black Friday.
People are planning and researching what they want prior to the sales starting. They come in and they're ready to pull the trigger on what they want.
Yes. And they aren't just looking to buy Christmas gifts.
I think a lot of people are shopping for themselves and want to maybe reward themselves. Maybe it's some turntable and a bit of vinyl, or it could be a new TV for the family room.
Australians are expected to spend a record $6.8 billion over the Black Friday Cyber Monday weekend. That's a 4% increase on last year. On average, they'll fork out $804 each.
November's become the new December when it comes to a lot of Christmas purchases, and Black Friday is driving a lot of that activity.
Research from Westpac and the Melbourne Institute shows consumer sentiment surged in November by almost 13%. It's the first time optimists have outnumbered pessimists in more than 3 years, with more people thinking it's the best time to buy a major household item than in the past 4 years. Consumers say they're trying to beat the Christmas rush.
Inflation is going really high, so we're going to get some discount on Black Friday.
I'm going for a Christmas party, so I think it's the right time to get a gift right now rather than waiting till Boxing Day.
Just getting some shopping done before it gets really hectic, to be honest.
Shopify works with retailers across the country. They did a survey of 2,000 consumers and 500 businesses that found many were using artificial intelligence to help guide purchases.
They're using AI for product discovery to find the next best product, but also using it to find brands or to find offers as well. So we've seen an uplift where retailers are now seeing 7 times the traffic from the beginning of this year to now directly to their sites from AI.
A recent study by economic think tank E61 found that when the Reserve Bank hiked interest rates in 2022 and 2023, higher levels of savings meant the RBA changes took longer to have an impact. Mortgage holders are using their offset accounts as a buffer. The Reserve Bank's now expected to keep the cash rate on hold until next year, and some economists even think the next move might be up rather than down.
We are hopeful around seeing further interest rate relief in the future. We would be very concerned if there were any future interest rate increases. They would most certainly have an impact on consumer spending. We would not like to see retailers go back into that period of subdued consumer spending that we've had for quite a long time now.
For now, retailers reap the rewards as Australians continue to splash the cash.
New insights from the country's biggest bank show the rise in spending is not just driven by Christmas. The CommBank Household Spending Index for October matched September's gains and shows an improving and more consistent pace since March. The biggest gains by category were in transport, motor vehicles and hospitality. But the bank notes higher than expected inflation in the third quarter suggests some of the spending increases were driven by price rises rather than growing consumption. It points out uncertainty about further rate cuts may curb spending going forward. Borrowers' hopes of a rate cut have been pushed well into next year after a better-than-expected jobs report. Unemployment fell to 4.3% in October, undercutting RBA and market forecasts. More than 40,000 jobs were added, but as David Taylor reports, for highly skilled job seekers, the numbers don't tell the whole story.
It's been a rough few months for 41-year-old job seeker Simon Torrick. He found himself looking for work midway through last year after being let go from a full-time gig.
So I went through the process of becoming an independent contractor, got my ABN, went through all of the process of what that is, and came back in a very different capacity.
But he's back out of work again and says it's soul-destroying.
I've applied for 320 jobs in 6 months. and I've had 7 interviews. And if you're at that point, you just think, well, what am I doing wrong? What is it about me or my CV or my LinkedIn profile that isn't pushing the needle for these people?
The latest official employment data show the unemployment rate has dropped from 4.5% to 4.3%. Full-time jobs increased by 55,300, while part-time jobs decreased by 13,100.
So understandably, the demand for housing remains, construction workers' demand remains. Retail is expected to pick up as we go into the end of the year. When it comes to technical services and industries such as IT or data analytics, that's an industry that has consistently seen a steady demand for workers.
We've seen on Seek, we did see a boost in that typical seasonal hiring back in August and September, ready for Christmas. Black Friday starts earlier than Christmas. We're seeing that seasonal shift in employment. So there's been a lot of Christmas casuals, a lot of holiday sort of hiring in the retail space.
The government welcomed the figures.
This historically low unemployment rate means that there are more Australians in jobs, and of course the employment growth also indicates there are more Australians in jobs.
Economists say the jobs market is still tight enough to keep the Reserve Bank on the interest rate sidelines for a little while yet. It means mortgage borrowers might have to wait until the middle of next year for a potential rate cut.
And the risks are firmly anchored towards the rate cut being pushed further back later into the year than coming soon.
And while the official jobless rate may be relatively low, it seems to be getting harder for those hitting the pavement in search of work.
So it's a very competitive market when it comes to applications per ad. We're seeing record high applications. We know it's due to new applicants coming in. I think it reflects that, cost of living pressures have been tough.
I would like very much to be in a role before the end of the year. Knowing what December and January is like in Australia in the market, it is not a fun place to try and be looking for work. I am hopeful that something will come good before the end of the year.
A Christmas wish in uncertain times.
As hopes for rate cuts faded, so too did the gains on the share market. Selling intensified at the end of the week. The ASX 200 slumped 1.5% and the All Ords ended the trading week off 1.4%. Kyle Rodder from Capital.com joined me from London. Kyle, we saw markets in the US and Australia both sell off at the end of the week, and in both cases it seems interest rates were the main catalysts. What's going on?
Well, effectively what we've seen in the United States is the Fed try to give itself maximum optionality going into its December decision. We saw the first signs of that in the last meeting where the Fed head, Jerome Powell, told us that a December cut was not a foregone conclusion. And since then, a whole swathe of Fed officials have come out warning against basically persistent inflation risks, a lot of that due to the fact that a lot of cuts have already been priced in and there's still a lot of fiscal support going into the US economy, and that effectively they can't be fully confident that inflation is under control. So not that the Fed doesn't want to cut in December, it just wants the option not to. So we've seen market pricing adjust quite significantly. And, if you do look at the domestic situation, it's quite similar in Australia as well. Above target inflation, policymakers worried that it might be getting out of control and rate cuts coming out of the market. So it's a richly valued market. And when interest rate cuts get basically priced out, asset prices have to more or less reflect that. And obviously in this instance, pretty violently this week.
Well, as you say, it's a richly valued market. Stretched valuations, particularly in the AI sector, are in question. Now, is air just leaking out of the bubble or is it likely to burst?
Well, it's probably interesting to define what kind of bubble we could be looking at the moment. And, arguably we're not seeing a financial bubble because we've got these companies in the United States, the Magnificent Seven, still posting significant profits. But the question is whether all the physical resources basically being pumped into the artificial intelligence industry by government and private sector alike is a bit of a misallocation, and that we won't see a return on investment going forward on some of these massive investments that are being made. The earnings that we've seen this reporting period for US corporates are good without being absolutely stellar. And there's still this kind of question about, what will artificial intelligence do to the economy? How will it drive growth and productivity? Will it be as revolutionary as markets seem to be implying? Or will it be something, still spectacular, but not quite justifying the rich valuations that we've recently seen that have rivaled, the dot-com bubble as well as the COVID bubble? So for now, this just seems like the market kind of moderating just a little bit, some steam coming out of things. But again, there's some serious questions about AI ROI there that still need to be answered.
Well, the US government has opened back up after the longest US government shutdown in history. Was there any impact on the market?
Yes, and I think that was perhaps something that surprised market participants in the last week or so, was just how significant this had proven to be for market sentiment, as well as potentially economic fundamentals, which we'll now start to get a better picture of, that the data is being released again. More or less, we saw a very big relief rally last week on Wall Street when it became apparent that a deal was on the cards, and obviously it did materialize eventually. And also on top of that, the kind of weakness that we did see in stock prices in response to consumer confidence data in the States, which basically showed confidence near record lows, not just because of inflation, things of that nature, but also because of the government shutdown. So typically these things have short-term impacts. There's pent-up demand there that should mean that the US economy bounces back. But certainly it's something that, weighed on market sentiment. And obviously the deal was a reason why we did see, for a brief period, a bit of a rally on Wall Street this week.
Kyle Rodder, thank you so much.
Thank you.
The Liberal Party's decision to join the Nationals and dump net zero has been met with scepticism from green energy investors. Liberal leader Susan Lee claims a mix of coal, gas, nuclear and renewables will provide a reliable path to the energy transition, whilst lowering prices and maintaining the Paris Agreement to lower emissions. Investors who spoke to the business disagree that dumping net zero offers certainty.
It says we're going to put ideology first over anything kind of sensible and durable over the long term. The reality is that we've got to do something to replace the coal, and we've got to do something to displace the gas, which are both very expensive, or in the case of coal, just getting old and needing to be replaced. What we have here is a pretend that there's some easy solution that we can just hark back 30 years and turn back time, and suddenly energy prices will be cheap. And the moment that we opened those liquefied natural gas plants in Gladstone, we completely unravelled any chance of that happening by just going back in the past. We just opened a Pandora's box with that, and the only real solution is to use less gas, and we've got to replace the ageing coal-fired power stations if we want to come up with something that's sensible, reliable and affordable.
Shadow Energy Minister Dan Tehan says carbon capture and storage is key to reducing emissions, a view rejected by green energy investors.
I thought that was just a complete joke. Carbon capture and storage is incredibly expensive, and you'd be looking at a doubling to tripling in electricity prices if you wanted to resort to that technology. It's not a cheap option.
Despite the about turn, it was the Liberal Party who set the net zero 2050 target back in 2021 under former Prime Minister Scott Morrison after a similar debate within the coalition. It was then legislated by the Albanese government. The nation's fourth largest lender was the last of the Big Four to unveil its full-year results, revealing a hit to its profit margins. ANZ saw a 14% slump in its cash earnings, crimped by fierce competition in the lending space, legal penalties and layoff expenses. And as David Taylor reports, analysts say the banking sector is set for a shake-up as the economy faces more headwinds.
Towards the home corner, flatten the curve, has got a lot to do.
The Reserve Bank fears the Australian economy is on the rails. While rate cuts soon are possible, they're not probable.
I don't think you have to be mad or sort of a fanatic to think that future rate cuts could be coming.
Low productivity and wages growth, leaving the constant threat of inflation as the economy attempts to gallop.
You might worry about how much remaining room there is, given that picture of capacity pressures. You might think the economy is a little bit boxed in.
That squeeze is now showing up in the profit growth of the Big Four banks. ANZ's earnings have slumped 10% over the year to $5.9 billion. The bank is slashing costs to improve its margins, including showing more than 3,000 employees the door. Analysts say the bank is also being squeezed by lower interest rates and competition for deposits, red tape holding banks back.
Australia's always stuck in the slow lane. It's very hard, just based on our economy and our lack of business investment.
The past decade has been a dream run for Australia's Big Four banks, expected to rake in about $30 billion in profits this financial year, helped by surprisingly strong loan growth, cost cutting, and low numbers of borrowers struggling to repay their debts. CommBank's earnings rose 6.5% to $10.1 billion. Westpac's full-year profit fell 1% to a still healthy $6.9 billion, while the NAB made $6.7 billion last financial year, down 4% on the previous year. But with the growth of AI and increasing competition, analysts say the banks are gearing up for a pace of economic change they've never experienced before.
So the banks are really looking at how do they need to shape themselves for the future and how can they really grasp the opportunity presented by technology.
Also nipping at the heels of the big banks is a wave of non-bank lenders, from credit unions to private credit companies, all wanting a greater share of the loan market. But it's the rapid expansion of this sector of the market that's making analysts uncomfortable.
Now it's all outside the banking system, which creates its own problems. You have these loans which are not backed by capital or regulatory supports.
The majors are continuing to lose some market share overall to that part of the sector.
And that could be further tested. The accounting firm PwC has at least one more RBA interest rate cut penciled in before the end of next year, a silver lining in an ongoing cost of living crisis.
It's been lauded as one of the most expensive banks in the world, but this week the crown slipped for the Commonwealth. $26 billion was wiped off the bank's market value in just 2 days, with investors spooked by a flat first quarter profit, shrinking net interest margins and rising costs. The $2.6 billion unaudited cash net profit after tax was 2% higher compared to the same time last year. John Story is the head of banking research at UBS. I spoke to him earlier. John Story, welcome to Close of Business.
Thank you. Thanks for having me.
CBA's found itself in the rarefied position of being at least one of the most expensive banks in the world, if not the most expensive. Was the quarterly result that bad? Did it justify it losing its crown?
Listen, the quarterly result was not as bad as what the share price reaction has been. There's probably 3 areas in our view that stood out. One was the margin was probably a little bit softer than expected, but that was only 2-3 basis points. Capital was probably a little bit lighter too, probably declined by about 50 odd basis points quarter on quarter. And then I think the key one, which people and the market is very focused on, is costs. Costs are a little bit higher, but admittedly there were 1 or 2 one-offs actually within the cost number. But CBA printed $2.6 billion in quarterly earnings. It's very much on track to meet first half expectations from consensus.
The stock hit a high of $192 intraday in June. It's now at about $160. It's fallen 10% this week. What's your view of the valuation of the stock now?
Yeah, so CBA trades now today at about 24 times forward earnings. And I think, as you alluded to, it's still actually one of the most expensive developed market bank stocks in the world still. Earnings expectations around CBA, if you go and look at consensus forecasts over the next 2 or 3 years, are actually still quite low. So there's not a lot of growth coming through from CBA. It's derated from 28 times to 24 times. But if you go and look at the long-term average in terms of where CBA is traded, it's traded roughly at about 17 times, right? So it's still quite expensive, I guess, on a historical context.
What kind of price target would you put on it then?
We've got an official price target on CBA of $125 a share. And obviously the stock, to what you're alluding to now, is trading roughly at about $160 odd a share. So, you know, arguably from fair value, where we see fair value, there still is a little bit of downside from here.
Well, mortgage competition has been described as intense. It is squeezing margins for the banks. How do you see a way through this?
Listen, I think for what it's worth, CBA is obviously the largest player in the mortgage market in Australia, and it's done a fantastic job over the last 2 years navigating what arguably has been a far more competitive backdrop to what we've seen historically. They've been able to defend market share, defend margins to some extent, and they've been quite tactical in terms of where they've been able to grow, and they've leaned in on their proprietary distribution capabilities. But, you know, this level of competition is not going to go away, certainly over the next few years.
We look now like it's very unlikely we're going to get rate cuts anytime soon. How does that feed into bank profitability?
Well, normally what happens in an Aussie bank context is your liabilities would reprice a little bit quicker than your assets. So as rates start to come down, you might see margins start to open up a little bit. But generally, these are variable rate back books that the banks sit with, and as margins or as interest rates comes down, usually you start seeing some margin pressure for the banks, and that's really what the market is expecting. So if you go and have a look at consensus forecasts for the aggregate of the big four banks, there's probably about 2 basis points of margin compression baked into consensus forecasts.
So given that we're not going to see rate cuts, then does that change it?
It might, right? Margin compression might not be as extreme. I mean, we're talking about extreme levels here, 2 basis points. It's not a big number in the greater scheme of things. But I think what is potentially going to offset some of the potential margin pressure that the market has baked in is the fact that the banks are actually growing very, very strongly on the lending side.
There seems to be an arms race in the technology space between the banks. CBA has been out in front with AI, really the nuclear option, but that is coming at a cost.
It is. I mean, all the banks, if you go and look at the size of the investment envelopes, ranges from $1.5 billion all the way to CBA, which spends $2.3 billion a year in terms of the investment envelope. So there is a lot of focus, there's a lot of attention around potential productivity and efficiency gains that the Australian banks could ultimately eke out. And I guess within that context, the banks already are actually very competitive if you look at where they operate in terms of their cost to income ratios globally. Particularly CBA, it operates with a cost to income ratio of 45%. Best of breed globally probably sits at about 40, right? So AI could be an enabler of improved efficiency. And obviously the banks are spending money to try and deliver that for all stakeholders, actually.
Well, when we look at the bank's outlook, where is growth coming from and where are dividends going to come from?
Yeah, well, one of the areas that we've written about during the course of this year, which we think has been underappreciated by the market, is the fact that business lending is actually growing very, very strongly. So if you go and have a look at the monthly statistics that we follow from APRA, you'll see that business loans are actually growing on a year-on-year basis of roughly 9%, and penetration rates there relative to long-term averages have actually declined, and we think that they could increase. So a lot of the growth that we see within the sector is actually going to be business lending driven. And business as a product category and vertical is a lot more profitable than what you see in mortgages. So we think that could actually underpin bank profitability and dividends.
John Story, thank you so much.
Thank you.
Guaranteed privacy is a fundamental expectation for IVF patients. But now there are calls for the Information Commissioner to formally investigate the nation's third largest IVF provider over concerns about cybersecurity. Janaea Fertility was hit by a cyber attack in February, and the personal information of patients was later posted on the dark web. At least one class action law firm is circling. Rihanna Whitson reports.
And you're actually pregnant.
People turn to fertility clinics like Janaea in their most vulnerable moments. In February, that trust was broken when cyber criminals stole sensitive patient data from Australia's third largest IVF provider, which was then posted on the dark web.
My medical history, my ancestry, my ethnic background, medical conditions I've had in the past, psychology sessions as well, all the data from that and information from that, mental health history, family disease history.
A line crossed so private, the child born as a result of Nicole's life-giving gift to her friend doesn't yet know they were conceived from a donor egg.
It should be the biggest priority for a company to protect the data of patients. They are being paid after all, to provide services to people who are very vulnerable.
It's really a nightmare scenario, isn't it? All the people involved, my heart goes out to them.
Cybersecurity experts say the seriousness of the Janaea hack is comparable to the cyber attack on Medibank.
The impact is at least as big, if not bigger. The data loss here and the effect on people's privacy and the effect on people's mental well-being is potentially vast. I can't actually imagine a worse one.
Now the ABC can reveal fresh concerns about Janaea's cybersecurity, with a report lodged by ethical hacker Jameson O'Reilly calling for a review of one of the company's applications used by customers. Janaea has confirmed the report, but wouldn't comment further. In a statement, the company apologised for the February data breach, saying, "We are committed to learning from this incident and we have already taken steps to further strengthen our security upon the advice of external experts to mitigate the risk of future cyber incidents."
We know that worldwide medical data is highly prized. Companies that hold medical data, especially sensitive medical data, should know they're on the radar for the bad guys.
Rebecca Craven was not a victim of the cyber attack, but she's worried. She's asked Janaea to delete her data.
They came back to me with quite a stock standard response saying that they have to hold the data for a certain period of time. That didn't sit well with me.
The mother of 3 used Janaea for routine genetic testing when she was pregnant with her daughter.
You were that small? I should be able to say whether or not I want that held. And if it's not medically necessary to have that data held on somebody's systems, I don't see why I shouldn't be able to say, please delete this data.
With ongoing secrecy about how many people were affected by the Janaea cyber attack and how it happened, there are calls for the Office of the Australian Information Commissioner to take regulatory action. At this stage, the watchdog is yet to decide if it will launch a formal investigation.
This is not the sort of behaviour that we can walk past.
I would like to see Janaea held accountable in the courts for what they've done through the voices of the people that were affected by it.
A privacy breach with real-life consequences.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.